Hello, welcome you all to the world of accountancy. So let's begin with the introduction to accounting. See the definition of accounting here. According to American Institute of Certified Public Accountants, that defines accounting is an art of recording, classifying, and summarizing in a significant manner and in terms of money, transaction, and events which are in part at least of a financial character and interpreting the results thereof. This is the definition provided by AICPA, which is the governing body of accounting practices. So in this definition itself, we can see that main four functions of accounting: recording, classifying, summarizing, and interpreting or communicating. So if once ask you what is the definition of the accounting, you have to say this definition. According to AICPA, accounting is an art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions, and events which are in part at least of a financial character and interpreting results thereof. So what this definition means? Does it gives any meaning to you? So let's move on the meaning of accounting. So simply we can say that accounting is the process of recording, classifying, summarizing, analyzing, and interpreting the financial transactions and communicating the results to the interested persons. So, all over, accounting is the process of recording, classifying, summarizing, analyzing, and interpreting the financial transaction. The financial transactions of an entity of a business organization. So the financial transactions of a business organization are recorded, classified, summarized, and interpreted in a systematic manner and which are communicated to those interested parties. The entire process is termed as accounting. So I hope that all of you now got a brief idea about accounting. So let's just unbox the definition of accounting. This definition which we have seen in the previous slide, I mean the definition provided by AICPA. So it was said that accounting is recording economic events. What do you mean by economic events? It means the business transaction. All the business transactions which are having some economical value, some monetary value or termed as economic events. So these economic events can be external or internal. See, external economic events means transfer of something of value between two or more entities, where the money goes out of this entity or money comes in from the outsider entities. That's the external event. For example, payment of wages to employees, purchase of goods from suppliers, sale of goods to consumers, etc. So external economic event refers to transfer of something of value between two or more entities. Then internal events. Internal economic events take place within the organization, just like issue of raw materials from stores to production department or transfer of this much value of goods from one department to another, supply of stationery items to the office, return of raw materials from production department to stores. So where the economical activities are carried out internal to the business, it is termed as internal economic event. So accounting is a process of recording economic events. So economic events can be external or internal. Then identification, measurement, recording, and communication. These are the four main functions of accounting. Let's see. Identification means It involves identification of the events that are to be recorded in the books of accounts. Hmm? What are the trans It means what are the transactions or events which are to be recorded in the accounting process. So identifying, I mean, in an organization there might be thousands or lakhs of transactions. So identifying those transactions that are to be recorded in accounting practices or accounts books. In a business, there might be some financial transaction or non-financial or non-monetary transaction. There are different transactions. So the first process or the first functions of accountant is to identify whether this transaction is to be recorded or not in the books of account. Second, measurement. And as we have seen in our definition, accounting records all the transaction in terms of money. So all the transactions that can be measured in terms of money are only recorded. So all other non-monetary transactions are ignored in accounting practices. In accounts books, non-monetary transaction cannot be recorded. So only monetary transaction, for example, sale of goods, purchase of machines, payment of salary, payment of expenses, etc. So whenever there are some money transaction, it can only be recorded in account. So all the transaction can be measured in terms of money are recorded. Then recording. So first we will identify there is a transaction. Then we have to measure those transactions in monetary terms. So if it is capable of measuring those transactions in monetary terms, then we can record it in our accounts books. Then communication. After about 3 cases, after identifying measurement, we will record the transaction and we will communicate the result to the interested parties. The parties may be internal or external to this business. So these are the main 4 functions. Then organization. Organization is an entity that stands for performing business activities either for profit or not for profit. So organization means is the entity. Every business is an entity is having its own existence from its owners. So if a person start a business, that business is having a separate entity, a separate existence from this owner. So there are different forms of business organizations are sole proprietorship, partnership, cooperative society, company, municipal corporation, and so many. Then users of accounting. Who are the users of the accounting? The users are mainly categorized into 2: internal users and external users. Internal users includes the persons who are in the business or in the organization. For example, CEOs or Chief Executive Officers, Financial Officers, Vice President, Business Units Managers, and all other managerial persons. They all are internal to this business. The next, external users. All the persons or interested stakeholders which are external to this organization. This may include the investors, creditors, banks and other financial institutions, authorities, regulatory agencies, trade associations, stock exchanges, etc. So the users can be classified into internal users and external users. Then branches or disciplines of accounting. Mainly there are 3 disciplines of accounting, 3 branches of accounting. First one, financial accounting, is the original form of accounting which is used to find out the results of operation and to provide information about the financial position of the business. This is the real form of accounting. So it's the process of ascertaining whether the business is earning any profit or loss or what is our exact financial position of the business. So they are the real accounting process, financial accounting. And the next branch is management accounting. It is concerned with acquiring information that is useful to management for decision making. But for this management accounting itself, they need the help of financial accounting. The results of financial accounting are transformed in a way in management accounting in a way to make decision by this management. So here the various result of the business calculated in financial accounting will be transformed in management accounting in such a way that the decision can be taken by this management. The next is cost accounting. It is the process of accounting for costs by which cost of products or services are ascertained and controlled. So these are the three main branches of accounting: financial accounting, management accounting, and cost accounting. Then qualitative characteristics of accounting. The first one, reliability. Accounting information is considered to be reliable if it is free from bias and faithfully represent the facts. Then only it is termed as reliable. It should be free from all biasness or errors. It should be free from all errors, or it should be much more reliable. Then only we can rely on our financial data, and then we can make our business decisions or investment decisions. So the reliability is the first qualitative characteristic of accounting, and the second one is relevance. The information to be relevant must be available in time. The principle of relevancy. So while we doing the accounting practice, all the relevant information should be available in time, and the irrelevant factors should be ignored. Only relevant informations are needed for the decision making. So if there is anything which is irrelevant, should be ignored. Then understandability. The accounting books carried out should be understood by those whom it is communicated. If the financial statements prepared under these accounting practices should be understood by those parties who are looking into it. That's one of the base qualitative characteristics of accounting. Then comparability. It means that accounting reports should be comparable with other firms to identify similar or differences. So whenever we need to compare two different firms, which one is working better or not, by comparing their financial statements, we can say that this company is better than this, and so on. So these are the four qualitative characteristics of accounting. Then, what are the objectives of accounting? So the first objective is to maintain business record, to maintain accounting data, to maintain business data. That's the first accounting objective. And the second one, calculation of profit or loss, whether the profit is, whether the business is working good or not. That's calculation of profit or losses. The next, ascertainment of financial position. What is the current net worth of this business? So this calculation of profit is made through the profit and loss account, and the ascertainment of financial position is done through the preparing balance sheet and provide information to the interested users. These are the main four important objectives of accounting. Then there are different terms related to accounting that you should know. So we are going to basic accounting terms that you should know in order to be a good accountant or be a good accounting student. First one, entity. Entity means a reality or existence that have definite individual existence. Just like a person, just like a normal person, a business having its own existence apart from its owner. That existence is termed as entity. So every business is a separate person or an artificial person apart from its owner. And the second one, transaction. Transaction is the dealing of businessmen with an external party which can be expressed in monetary terms is called business transaction. So all the dealings of business in monetary terms can be a business transaction. So business transaction refers to all the dealings of the business with its external parties expressed in monetary terms. So we can say that all the economics events which are external and internal to this business can be treated as transactions. Then next, assets. Assets are the economic resources or material things, properties, or possessions of the business, including amounts due from others, which can be expressed in monetary terms. So any things which the business owns and which having some value can be termed as asset. So assets are something which the business own and which can be expressed in monetary terms. And the assets are broadly classified into current assets and non-current or fixed asset. Current assets or fixed asset. So current assets refers to those assets which are held for less than 1 year is termed as current assets, and non-current assets are held for more than 1 year. So let's see the diagram of the classification of assets. Assets can be broadly classified into tangible and intangible, and both can be subclassified into tangible fixed assets, tangible current assets, intangible fixed asset, and intangible current assets. And the other forms of assets are fictitious asset. Fictitious assets means which are not the real asset, but for the technical purposes we treated them as asset. Then contingent assets. Contingent assets are those assets which are not asset at the right time, but based on some conditions in future it may become as an asset. That's the contingent assets. And few more are there, just like wasting asset. Wasting asset refers to all the asset which are get exhausted by the extraction, just like quarries and mines, etc. So this is the asset. Assets are the resources of the business which having some value. Then liabilities are the obligations which an enterprise owes, or these are the obligations of the business to be performed in future, just like creditors, loans, etc. Then capital. Capital is the investment made by the owners to start the business, or investment or any contribution made by owner to the business is termed as capital. Then sales, it represents total revenue earned by the business through the sale of goods or services to the consumers. So it's the total revenue earned by the business through sale of goods or services. It includes both cash and credit sale. Then revenue. Revenue is the total of all income. It represents the amount a business earned through the sale of its products or providing its service, and it also includes earning like interest, dividend, rent, commission, etc. So all the incomes of the business is termed as revenues. Then expense. It represents the amount spent to earn revenue. The amount spent to earn revenue is termed as expense. Example, rent, wages, salaries, etc. Then expenditure. Expenditure refers to spending money or incurring a liability from some benefits, service, or property received is called expenditure. So expense and expenditure both are different. Expenses are the short term and which are incurred for the less than 1 year, and expenditure refers to those spending of money and whose benefit will be available for more than 1 year. For example, purchase of goods, purchase of machinery, purchase of furniture, etc. Then profit. This is the excess of revenue over the expenses in an accounting year and represents increase in capital. So as the profit increases, capital also increases, and vice versa. Then gain, a profit that arises from events or transactions which are incidental to business, such as sale of fixed asset, winning of court case, appreciation of the value of an asset. So profit are the common revenue. Profit is known as the common revenue, and gains are the incidental earnings of the business. That's the difference between profit and gain. So profit refers to the revenue over expenses, and gain refers to the incidental earnings of the business. The loss is the excess of expense over revenue in an accounting year, is the just opposite of profit. Then voucher. Voucher refers to the documentary evidence in support of a transaction is known as voucher. A documentary evidences or a supporting evidence of a transaction. For example, if we buy goods for cash, we get cash memo, or if we buy on credit, we will get invoice. Then if we make a payment, we'll get cash receipt. All these are the different vouchers which are the documentary evidence of those transactions. Then goods, it refers to commodities, products, articles or things which a trader deals and which are meant for sale. All the commodities purchased and meant for sale. So all the commodities purchased for reselling is termed as goods. Then drawings. It represents the amount of cash or other asset withdrawn by the owner from the business for his personal use. Is termed as drawings. So it's just opposite of capital. Is the amount withdrawn by the owner for his personal purpose. Then purchase is an expense incurred for procurement of goods in a business. Then stocks represents the unsold goods. Stock refers to unsold goods at the end of an accounting period, which includes unsold stocks or unsold goods, raw materials, semi-finished goods, etc. And it's also known as inventory. Stocks also known as inventory. Then debtors or accounts receivable. A debtor is a person who owes money to the business as he has received some benefit from the business. So those persons who owes money to the business. So if we made a sale on credit, we got a debtor because he'll pay us in future. So he owes us the money of that value of sales. Then creditors. A creditor is a person to whom the business owes money as he has given some benefit to the business. When we make credit purchase, the creditors arise, then we have to pay him later. So these are the basic terms of accounting. Now we are completing our part 1. So I think all of you got the basic introductory theoretical aspects of accounting. Okay, thank you. Bye.